Hello and welcome to this video on Cashflow. I'm going to start off today by showing you an exciting extract from my diary last Saturday. At 9 o'clock in the morning I got out of bed and put £50 in my pocket and left the flat. 10 o'clock I went to the supermarket and spent £35. At 11 o'clock I picked up my winnings from the lottery, £10, get in, and at 10 past 11 I bought my weekly copy of Business Teacher magazine. Can't believe it cost £7. At 12:30 I had my lunch, a lovely spicy meatball ciabatta, £4. £5 I met my friend, he paid up because the Mighty Dons beat Accrington Stanley, £5. To celebrate my wild Saturday night I went to the pub and bought myself an orange juice for £2.50. Now what we can do with this information, despite appreciating what a wild life I have, is to look at the flows of cash I received in and out the day. So to start off with, at 9 o'clock, putting £50 in my pocket, the value of that transaction was plus £50 to me. I put that in my pocket. So at the end of that transaction, I would have £50 in my pocket. I went to the supermarket next and spent £35. So I'd have £15 left in my pocket after that event. The £10 from the lottery would have been plus £10. So that would be added to the 15. So I'd have £25 in my pocket. The copy of Business Teacher magazine would be minus 7. So that would leave me with £18 in my pocket. The meatball ciabatta would be minus 4, cost me £4, leave me with £14 in my pocket. My friend paying up because of the Mighty Dons would be £5 in my pocket coming into me, so £19 overall I would have. And then my celebratory orange juice, minus £2.50, would leave me with £16.50 at the end of the day in my pocket. I could have summarised my transactions into the following categories: cash inflow, all the cash I received throughout the course of the day, the 50, the 10 from the lottery and the 5 from my friend, 65, all the cash outflows, all the cash I spent, to leave me my net flow of plus £16.50, money I had at the start of the day and money I had at the end of the day. And that would summarise my cash flow for Saturday, and it's a very similar idea for business. And that's what we're going to look at in this video. We're going to look at what is meant by cash flow and why it's important. Secondly, what a cash flow forecast is and how and why businesses do it. And then lastly, what is the difference between cash flow and a concept we've done earlier this term, profit. So to get us started, what is cash flow? Cash flow is the amount of money flowing into and out of business over a period of time, and that's an important definition you should take down in your notes. A good way to think about this is it's a bit like a bathtub, in that cash inflow is like the money flowing or the water flowing into the bathtub, and cash outflow is like the money flowing out of the business or water going down the plug hole. And if you think about it, the level of the water in the bathtub is similar to how much cash the business has in the bank. Another important key term is net cash flow, and net cash flow is the inflows minus the cash outflows. So what comes in minus what goes out over a certain period of time. And again, you should take that down in your notes. So cash flow is important. A business needs cash in order to set up the business and get it started, to trade on a day-to-day basis, and to enable it to expand, invest and grow in the future. Now there are many kinds of items that would count as cash flow. There are many kinds of inflows, and if you think about it, probably the main inflow for most businesses would be from sales, like revenue. But that's not the only source of cash that a business might receive. They might receive a grant from the government or take out a loan from a bank. And if you ask yourself, is this revenue? Is this money they've received from selling products? You would say no. But is it cash the business has actually received? Yes. So cash inflows are any amounts of cash the business receives, and here are some examples. Cash outflows is any cash the business pays out. So maybe to suppliers, but also things like tax, any interest payments on loans, and also things like dividends, money that's returned to shareholders. Now here's a good question. What happens if a business runs out of cash? Well, if a business runs out of cash and is unable to pay what it owes, we describe the business as being insolvent. If you or I run out of cash, we're described as being bankrupt, but for a business, it's described as being insolvent. The business doesn't have any cash left to meet any payments. In that situation, the business will either have to restructure the payments that it owes with the people it owes money to, or the business might be forced to shut down. And if the business shuts down, we call this process liquidation, where all the assets of the business are sold off so that the debts can be paid off and then the business just ceases to exist. Can you think of any businesses that you might know of that cease to exist, have run out of cash and shut down? There have been quite a few examples in recent years. For example, Woolworths. And when Woolworths was liquidated, you could even buy the tills as they sold off all the assets of the business. A number of football clubs as well have also faced issues with running out of cash and have entered liquidation. So cash flow can cause a number of problems for a business, the biggest one being that they run out of cash and go insolvent and end up having to stop as a business. So businesses need to have sufficient cash to meet their day-to-day finances, like buying stock, paying their staff, or perhaps their energy bills and things like that. If they don't have enough cash, they may have an inability to meet any debts that they owe, maybe pay off their overdraft or pay any money to suppliers that they've agreed to pay in the future. Limited cash can also result in the business missing out on opportunities. There might be a great opportunity to run some advertising campaign, and because the business doesn't have enough cash at the time, they can't do it and they miss out on that opportunity. An important consideration should be whether the cash flow problem is short-term. If it's a short-term problem, they might be able to survive, but a long-term cash flow problem, one that persists for a long period of time, may prove to be insurmountable and the business might enter liquidation. So, we've looked at what is meant by cash flow and why it's important. We're now going to look at what is meant by cash flow forecasts, how and why businesses do it. So typically, businesses will record their cash flow in a certain structure. So if we have a look at this diagram here, we've got cash inflows first, sales and other inflows, A and B, and if you add all the inflows together, you get the total cash inflows. Then the business would normally list all its outflows, so costs perhaps and anything else that's a cash outflow, add them all together and you'd get the total cash outflows, C plus D. Now net cash flow, as we defined earlier, is the inflows minus the outflows. So if you work your way down, you've got inflows all added together, outflows all added together, the inflows minus the outflows gives you the net cash flow for that particular time period. The last bit to note on a cash flow structure is you often have the opening and closing balances, where the closing balance is calculated by saying, well, what did I start with? How much cash did the business start with, perhaps in the bank account? Add on the net cash flow, what happened during that period, and you get to the closing balance. Now, if what you closed with at the end of the first period, let's say the end of October, well, that's going to be what you start with on the 1st of November. That will be the starting opening balance in the next period. So a cash flow works its way down, and then the opening balance is whatever you finished with, the closing balance of the previous period. Let's look at a real example. So in this example here, we've got a cash flow forecast, and it's normally produced by month. We can see cash flows first of all, so from investment cash into the business and sales, total inflows, then we've got all the outflows, all the kind of costs, and the total outflows. Inflows minus outflows gives us the net cash flow, and then we have the opening and closing balances. So net cash flow is the difference between the inflows and the outflows, and then let's look more closely at the opening and closing balance. So if the business starts here at the beginning of February with minus £2,500, and during February the net cash flow was minus £2,000, then the business is going to finish with the closing balance will be minus £4,500 at the end of February. If at the end of February they have minus £4,500, at the start of March they will begin with minus £4,500. Here the net cash flow for March is positive, which brings us up to minus 1,500. So again, the closing balance is always the opening balance plus the net cash flow. So it's important you have these formulas down, the opening balance and the closing balance, in your notes. Now, why would a business produce a cash flow forecast? Well, the main reason is to try and identify any advance warning of cash shortages. If you're predicting that you're going to be short of cash, that you have a negative closing balance, for example here at the end of April, well then that should give you advance warning that you need to find some way of dealing with that, maybe getting a loan or changing what you're doing in terms of your inflows and outflows, or maybe finding a bank overdraft, something like that. Secondly, it can make sure the business has enough money, cash, to pay their suppliers and employees in the future. They can maybe potentially spot problems with the amount of cash that is being received from customers. Maybe they're forecasting 1 month, they're not going to receive enough cash from customers. It's an important part of the finance department to control the amount of cash coming into a business, because it's very serious if the business runs out of cash. It could be the end of the business. And the last reason is it can provide reassurance to investors and lenders that the business is being properly managed. If you were going to lend to a business, you would want to see their cash flow forecast for a number of months into the future, just to make sure you could be confident that you're going to get your money back. Okay, so we've looked at the second one there. What is a cash flow forecast? How and why businesses do it? We're now going to look at the last issue, which is the difference between cash flow and profit. And I'm not going to lie to you, this is quite a tricky concept. So, the distinction between cash and profit. Profit exists in a financial record when revenue is greater than cost. That was our definition from earlier in the term. So profit is a record of all the business that's being done, the revenue and the costs. Cash and cash flow is trying to record something different. It's trying to record all the actual physical movements of cash in and out of the business. And sometimes businesses that make a profit can run out of cash, which we call liquidity problems. And there's a number of reasons why cash flow and profit might be different. For example, credit sales or bad debts, or having lots of stock, seasonality, and repaying loans. So let's go through this. Profit is a record of the business that we do. It's a record of revenue, it's a record of cost, and that gives us profit. Cash flow is trying to show us something different. It's showing all the cash the business is receiving, all the cash that's leaving the business, and the net cash flow. Also in cash flow, we record the opening balance, how much cash the business started with, and the closing balance, how much cash the business finished with in its account. Now, cash flow is different to profit, and I think the best way to illustrate this is with an example. So, let's imagine this scenario. We have Talisa and Tiddy, and they install kitchens. They aim to fit 2 kitchens a month, and they plan to get regular customers, so 2 kitchens a month throughout the year. Now, they allow their customers to pay within 2 months of doing the work, because they found that customers like that. They like to have the work done, and then they pay a bit later. Their suppliers, the people they buy the kitchen units from, allow them to pay them the cash 1 month after they fitted the kitchen. They charge the customers £3,000, that's the price they charge the customers for doing a kitchen, and it costs them £1,500 to fit each kitchen. They start their year with £5,000 in their bank account, and we're going to look at their profit and loss and their cash flow. So let's start off with their profit and loss, or their statement of comprehensive account. This shows us here that we're doing 2 kitchens each month throughout the year, and we can see that they charge the customers £3,000 per kitchen, so their revenue, price times quantity, is £6,000 each month. The cost of each kitchen is £1,500, and they do 2 per month, so the costs are £3,000. So each month, Talisa and Tiddy are recording a £3,000 profit. That's what we looked at so far, and that's what we would understand as profit and loss. But let's think about it in a bit more detail. Let's think about it from a cash flow perspective. Now this shows us their cash flow, and what we might look at is, it's quite interesting at the start to look at what's happening in January and February. We've got 0 cash inflow in January and 0 cash inflow in February, even though we know that they're fitting 2 kitchens in January and 2 kitchens in February. So why might this be? Well, if you remember, Talisa and Terry allow their customers 2 months in which to pay the cash. So the work they've done in January, the revenue they've earned, £6,000, they wouldn't actually physically receive the cash until 2 months later in March, so they'd receive the £6,000 in cash in March. Now in terms of costs, the suppliers they bought the kitchen units from allowed them 1 month to hand over the cash. So whilst it's costing them £3,000 worth of work in January, actually they don't hand the cash over until February. They wouldn't pay the cash out until February, which means in January there's been 0 cash in and 0 cash out, so a net cash flow of 0. But in February they haven't yet received money from customers, but they have paid out to suppliers, so they'd have a net cash flow of minus £3,000 in February. And we can see the impact on their closing cash balance. So the £5,000 they started with goes down to £2,000 in February, and then it picks up and improves throughout the rest of the months, and by the end of August they would have £20,000 in the bank. Now does that cause Talisa or Terry any problems? Not really. they've always got cash in the bank, and so there's no real issues in terms of cash flow. However, we're going to imagine some unexpected problems. Events take a different course during the year. The customers they've signed contracts with in January and February delay having their kitchens done until March. So the 2 in January and the 2 in February are saying we want to do our kitchens in March. Now, knowing that they make a profit on these jobs, the price they charge, the £3,000, is greater than the cost of doing the work, Talisa and Terry commit to doing the work. So let's have a look at the impact on their statement of comprehensive income, where we can see they're not doing any work in January, not doing any work in February, but they're doing 6 kitchens in March. So in March, 6 times £3,000, a revenue of 18,000, costs of 9,000, so they would have a profit of £9,000. From April onwards, it reverts back to 2 kitchens a month, and they'll be making a profit each month. So this is a profitable business still. This business is making a profit every month from March onwards, and everything looks absolutely hunky-dory. Now let's have a look instead at their cash flow statement. So we can see in March there is 0 cash inflow because customers are allowed 2 months to pay up. So the work they've done in March, the cash, they don't receive until May. Let's have a look at the costs. In March they cost them £9,000 worth of work, but they don't have to pay that out until April, so that's when the cash outflow would show up. So if we have a look at the net cash flow, we have a negative net cash flow in April, but then in May it's positive, and June, July, and so on. Let's have a little look at the opening and closing cash balance once we've looked at the net cash flow. So they start with £5,000, and this doesn't really change until April when they pay out the £9,000. Now, all of a sudden, we have a bit of an issue here. The closing balance is £4,000, minus £4,000. Is that possible? They're trying to pay out £9,000, but they've only got £5,000 in the bank. Now this is a real problem for Talisa and Terry, and it could be resolved if maybe they could borrow, extend their bank overdraft to £4,000, or they could maybe take out a loan for £4,000 or borrow some money from friends and family, maybe just to top them up for that time period. And if they get through that short-term problem, then it looks like things will be fine in the long term. However, if we assume that Talisa and Terry couldn't get any source of cash, then this could be seriously bad news for the business. There is a risk here that this business could run out of cash, couldn't pay their suppliers, and the business would go insolvent and cease to trade. Poor old Talisa and Terry. There is a risk here the business could go insolvent, not enough cash to pay their debts, and it might have to close down. So the moral of the story is, always manage your cash flow carefully. So there's a number of reasons why a firm like Talisa and Terry's, a profitable firm that made a profit every month, might be short of cash. One might be that it's built up its stock levels. It's used the previous profits to buy more stock, and so it has stock rather than cash. So if it's due to pay a supplier or pay its rent or wages, it can't because it just has stock instead of cash. Another might be that it's giving credit to its customers. This was the example that we looked at. Because Talisa and Terry gave 2 months credit to their customers, that period of time where they're waiting for the customers to pay up and they had to pay their suppliers caused them a problem, and they're a profitable business and they run out of cash. If the firm has used past profits to pay out dividends, pay the money out to shareholders, the cash is no longer in the business, it's with the shareholders, and so again they might be short of cash. If the firm has purchased fixed assets, it's bought a new machinery, well then it might have used all its cash to do that. It has the machine, but it doesn't have any cash, so it can't make any future payments. So these might be reasons why a profitable business that makes a profit might be short of cash and risks having a cash flow problem and potentially insolvency. There are also businesses though that often make losses but never run out of cash. A good example is many football clubs, for example Chelsea Football Club, Manchester City. These businesses every year, their costs are higher than their revenues, but they never seem to run out of cash. I wonder if you can think why that is. Well, the answer is they have shareholders who have lots of cash, for example Roman Abramovich, and they are happy to give cash to the business to continue it trading on a day-to-day basis, even though it's making a loss in terms of its revenue and its costs. So, in the long term, profitability is very important. It's important that a business's revenues are greater than its costs. However, Cash flow is very important in the short term. You can get profitable businesses that run out of cash for a particular reason and then cease to trade. So in the short term, it's very important that a business manages its cash flow. So in this video, we've looked at what is meant by cash flow and why it's important, what a cash flow is, and how and why businesses do it, and the difference between cash flow and profit.